Well, it's official. The median home price has fallen 4.1% year over year in April. That is the biggest drop on record in dollar terms and the largest decline since January of 2012 in percentage terms. And the month of April is actually marking the third consecutive month of year-over-year price declines following roughly a decade worth of price increases. That's going to bring the median sales price to just over $408,000. And if you've watched any of my prior videos, you've heard me mention that as we go into the spring and summer months, we're going to start to see larger year-on-year price declines. And that's because the market actually peaked out in May or June of 2022. So it takes roughly a year to start seeing those differences on a year-on-year basis. And one thing that I want you to pay really close attention to is what has actually happened over the last 12 months. So we saw month-over-month price declines going into maybe January or February of this year, but then look, there's an uptick in home prices again. And I think a lot of people are really curious as to whether or not this is a housing market head fake. In other words, are we watching more money get sucked into the market just to see more downward pressure on housing prices? Or have we found a bottom and we're in a position where the market is going to continue to go up from here? We're just readjusting to a new normal. And I think you could probably make a case for the market going up or down from here. It's just a matter of perspective, and there's so many different variables. But one thing that we can say that we know for certain is that the higher mortgage rates that we are seeing are keeping both buyers and sellers on the sidelines. This is a chart of new listings here, and they actually dropped 26.1% year on year. And this is the lowest level of new listings that we've seen dating back to 2012. And of course, the only exception to that would be March of 2020 prior to the pandemic. So we have some opposing forces or headwinds here in the housing market. And a lot of that has to do with affordability. So we're seeing higher mortgage rates, which is keeping buyers sidelined. But then we're also seeing sellers choose not to list their properties because they don't want to trade their 3% interest rate for a nearly 7% interest rate. And then, of course, in the mortgage market itself, the volatility is continuing right now. We see a lot of volatility in the 10-year Treasury yield, which mortgage rates tend to track rather closely. This is just a 5-day chart. We've seen some explosive movement to the upside, and we've seen a lot of intraday volatility here as well. This is driving mortgage rates to the highest they've been here in quite some time. We're sitting just over 7% right now for the average 30-year fixed mortgage on a conventional loan. And this is not to be doom and gloom, but the last time we saw interest rates over 7%, the actual amount of transaction volume really grinded to a halt. So we'll have to monitor where rates are here over the next couple months and take a look at some of this data as it starts to come available to see if that really impacts transactions. And this chart is a pretty good representation of what's sort of taking place. So the 30-year fixed mortgage is inversed here. So as it goes down, it means the rate is higher. This blue line is actually total existing home sales. And you could see that there is a pretty close correlation. In other words, existing home sales go down as mortgage rates go up. And one thing that we know right now for sure is that the amount of inventory that's currently available for sale is relatively low, especially seasonally speaking, because we generally tend to see more homes hit the market in the spring to summer months, and they typically peak in June. Now, I don't want to beat up the topic on affordability, but I did want to show you this really interesting illustration provided by Redfin, and this shows the difference between the cost of ownership versus renting a property and what areas is it technically more expensive to own than it is to rent. So they look at 50 major metros here, and the 4 in blue are the only metros where it's actually more affordable to own than it is to rent. So we have Houston, Texas, Cleveland, Ohio, Philadelphia, and Detroit. Those are the only 4 metros based on their assumptions where it is actually cheaper to own than it is to rent. And they're assuming a 5% down payment with a 6.5% 30-year fixed rate mortgage. Now, everything else in red here is actually more expensive to own than it is to rent. And the ones that I wanted you to pay really close attention to are these high-flying markets here. And these are markets in California where home prices got wildly disconnected to the local wages. So you have areas like the Bay Area, San Jose, San Francisco, Oakland, Southern California and Anaheim, Los Angeles, San Diego, and even Sacramento, where 100% of homes are actually more expensive to own than they are to rent. And over here, it shows the ownership premium. I'll go ahead and link to this in the show notes if you want to see this chart and make it a little bit bigger on the screen. But you can see like a market like mine in Sacramento, owners pay on average about 52% higher to own that property than they do to rent. And areas like San Jose are nearly 200% more expensive to buy a property than to actually rent. So I thought this was really interesting. And of course, at this time, it has a ton to do with where home prices are currently and then where mortgage rates are. So if we do see mortgage rates start to fall back down, these numbers will hopefully improve and it'll become a little bit more affordable for homeowners. Now, on a positive note, for what we're seeing unfold in the housing market today, even though it is sidelining some buyers and sellers, it is creating an opportunity for those who are looking to buy in this market and who are looking to sell. If you're a potential seller in this market, there is not a lot of new inventory that is hitting the market. So there's still major supply constraints, which means you can still command a premium. In fact, the low supply is arguably keeping home prices propped up really nicely right now. So if you are a potential seller in today's housing market, it might not actually be a bad time to get the property ready to bring to market. On the flip side, if you are a potential home buyer in this market, there is some opportunity that is starting to present itself. First and foremost, real estate agents as well as sellers are starting to get educated. They're becoming keenly aware of what is taking place in the market. So they're starting to price their properties correctly, number one. And number two, they are becoming more and more open to seller concessions. You might be able to structure your offer in a manner that has the seller paying closing costs, which means less out of pocket for the potential buyer, or you might even be able to get the seller to subsidize the rate with these rate buy down programs that are currently available. That could put you in a position where you could save hundreds of dollars on a monthly basis. And then if and when mortgage rates go down in the future, a big if there, I wouldn't necessarily want to purchase a home with the expectation that mortgage rates are going to come down. But let's say they do in the future, potentially you could refinance out of that higher interest rate, drop your rate and lower your monthly payment. And then in addition to that, there are several retail buyers that are sitting on the sidelines just choosing to rent. And there are also investors where they cannot make these numbers actually make sense right now. And the point of mentioning this is because a significant amount of the buyer pool is dropping off, which means there's less demand. So if the right property comes up and you're pre-approved and it's affordable for you, given your personal financial situation, there may be an opportunity to jump into the market and purchase that home now. But like anything, each and every market is different and each and everybody's personal financial situation is different. So make sure that you're consulting with a professional and make sure that you understand what a good deal looks like in your market. That is going to wrap it up for today's housing market update. If you found the information useful, please consider liking, subscribing, and commenting below. We'll see you on the next video. Thank you so much. Take care.